So one of the things that I've encouraged, some students who have asked me about business school is to, and I know you don't want to stay in school for a long time, but combine business school with something else. So like business school plus engineering, or business school plus science, or business school plus, I don't know, something else. And the reason is because, a lot of great opportunities are within corporations. And so if you have a specialization, so the biomed student, if you didn't want to become a doctor or go down that path, you could work at a corporation, but you can either then do research, or you could also do work in their corporate office in finance or whatever. So if you have that opportunity, I don't know what the curriculum looks like for students at ASU, but that's just one thing that I would lead with. Sorry, the sun is out today. Yesterday we had rain, like cats and dogs. And so the sun is now shining into my house, which is making it a little more comfortable. So do you want to go, you sent me a list of questions. Do you want me to just go through the questions, or do you want to have everybody ask me questions, or do a little bit of both?
So what we'll do is we'll go through the list of the more important questions that are relevant to you that I think members already would be very interested in. We've got some feedback on some questions that they'd like us to ask you. And then at the very end of the meeting, near the end, maybe the last 15 minutes, members can ask any question that they want to. And just for a heads up, members, I would encourage you to unmute yourself when you ask a question. Asking questions in the chat is of course okay. It's not required that you actually speak aloud, but if you could, that would be great. But yeah, that's kind of the format that we were going to take.
Okay. Well,
hey, Louis, this is Ann Jeanette. Before you guys get started, because I'm not going to stay on the call, but I just wanted to introduce myself. I am a colleague of Maya's. I'm actually here in our Scottsdale, Arizona office. And I happen to work in an area that specializes in insurance investment management. We talked a little bit about on Monday. I won't be able to stay on the whole time, but as a ASU alumnus, good job you guys getting involved in extracurricular type opportunities to kind of explore where you could take your studies. Maya's going to give you some good information, but again, since I have to leave, I just want to throw in a couple of 2 cents and just say, as I said on Monday, I would encourage you to just really think outside of the box, because there are investment related opportunities in areas, even with large S&P 500 corporations that are self-insuring now with capsurance. It's the space in the insurance space as it relates to investments holds a lot of opportunity. And I think historically it's just had a reputation for being a stodgy old man's industry, and it's just the opposite. So there's a lot going on as it relates to investment. I just wanted to throw that in because I won't be able to stay on the call the entire time, but keep thinking outside of the box and just network, and don't be afraid to ask people who they know and ask questions. So anyway, I don't want to take too much of Maya's time because she's got a lot of good things to share, but anybody has any questions, I'm here in the Scottsdale office. I'm happy to take questions, even have a coffee if you just are really have some serious ideas that you want to explore. So we encourage that and like to support particularly our fellow alumni. So
thank you for that, Ann Jeanette. And for everybody who's here right now, I'm going to send Ann Jeanette's email in the chat via our message relay to TMI members, and I can also put it in the chat here. So if you want to reach out to her and ask her questions and meet up with her, which would be incredible, you have the chance to do that. Thank you, Ann Jeanette. So starting off with just a brief introduction of Maya, this comes straight off the Madison Investments website, just so you get some background on who she is, what she does at Madison, what her responsibilities are, and also what her background is. Maya specializes in customized portfolio management for Madison's high net worth relationships at Madison. Maya also serves on the customized solution team, working with insurance asset management. Maya began her career at First Wisconsin Bank, U.S. Bank, in 1986. After her early years in credit analysis, Maya moved to the investment business. From 1993 to 1998, Maya co-managed the First Star Growth and Income Fund. Subsequent to her time at First Star, Maya worked at Wellington Management Company for 16 years as a portfolio manager on several strategies, including core equity, strategic growth, and focused equity. In addition to portfolio management, her role included fundamental research and client service. Prior to joining Madison in 2018, Maya served as a multi-sector analyst on the global equity team at Artisan Partners, LLC, focusing on companies in the United States, Europe, and Japan. Maya holds a BBA, accounting, an MBA, international business, and an MS in finance from the University of Wisconsin-Madison, including participated in the Applied Security Analysis program. So now that you have that background on Maya, I want to give her a chance to give an introduction to herself.
So just before I talk a little bit about myself and answer some of these other questions, how familiar is everybody with the investment world? You know what buy side and sell side means?
I think most people here do.
Okay. So as Lewis highlighted for you, most of my education was here in so I'm in Madison, Wisconsin, or just outside Madison, Wisconsin right now, where Madison Investments is located, and I grew up here. And after undergrad, I worked for one of the local banks for a few years, and then I went back to graduate school. So I did have a few years of experience working before I went to graduate school, which is always something that I think makes sense, because then you really know what you want to do long term. My undergrad was in accounting, so I've always been good with numbers, and so that was sort of, you know, what we thought made sense when I was 18 years old. Accounting's pretty boring, but it's a super, super strong foundation for what I do now. So, you know, I can find my way around a balance sheet and income statement. And if I hadn't taken all those accounting courses, maybe I wouldn't be as good as I am at what I do. When I went back to graduate school, I was going to I wanted to work internationally. So I love to travel. And so I thought, oh, I'll do international business. But international business as a major just doesn't quite give you enough basic foundation. And so I combined it with finance. And I started taking finance courses, and those really got me excited. I had started investing my own portfolio when I was 17 or 18. Bought a few stocks at that time. What happened was my parents, my brother and I applied for student loans, and my parents allowed us, because the rates were super, super low then. And my parents allowed us to keep that money in an account and sort of do what we wanted with it. So we both invested it. And so that's really where I got my first taste of investing. And the initial stocks that I bought were Intel and what was the other one? Sun Microsystems. So Sun Microsystems doesn't even exist anymore, but back in the 80s, those were, you know, some of the first technology stocks to come out, and they did super well. And so I got a taste of what it was like to, you know, buy a stock and have it do very well. And so finance, you know, really got me interested and excited, and I had some great professors. The Applied Security Analysis program is a really nice program that Madison has. I don't know if ASU has something like this, but students actually manage money that's been endowed to the university. So it's a year-long course, and you go in, first of all, you have to apply for it. So you have to take an exam, and then also get interviewed, because they want to make sure that you're super interested in investments. And then it's a year-long course where you develop, you're split into 2 teams, and you develop investment process and investment philosophy, and then you start to manage the portfolio according to that philosophy and process. So it's a super good background to get into the investment business, and I think probably gave me the best part of my foundation to do what I've done since then. After graduate school, I went out to the East Coast for a very brief time and worked at a convertible bond broker dealer. It was a very small company. So when I talk about a broker dealer, basically it's a sell side research. It was a sell side firm. And on the sell side, at the brokers, they put together research, they put together trading, they put together financing for the buy side to a certain extent. So at this small convertible bond broker dealer, we were selling convertible bond research to people who managed money. And I knew that after that very short experience there that I didn't want to be on the sell side, I wanted to be on the buy side. So on the buy side, you get to make the investment decisions, or you do the research, and then you buy the stocks, and you get, it's great satisfaction when you buy a stock and it goes up a lot, right? So I came back to Wisconsin in 1993 and joined First Star, and that's now part of U.S. Bank Corp. So I think you have some U.S. Bank branches in Arizona. So you're probably familiar with it. And there I started as an analyst and was made a portfolio manager relatively quickly, and managed a growth and income fund for a few years before leaving for the East Coast. I thought if I really want to be successful in the investment management business, I need to be on the East Coast in one of the bigger money centers. So I went to Boston and joined Wellington Management. And Wellington Management, I was there for 16 years. I was a portfolio manager on a large cap core product, which is an S&P 500 benchmarked product. We had a lot of institutional clients. And the other thing that Wellington does is they sub-advise for insurance companies and other companies that sell mutual funds. So our products, our clients were, we actually managed money for the Church of England. We managed money for a lot of pension schemes across Europe. We managed money for Hartford Insurance Company, things like that. So that was a great 16 years. And then in, 2014, I went to Artisan Partners. I moved to New York City and joined a global equity team there. And so did research and portfolio management on both global and international products, which was a lot of fun. It was different than what I had been doing because I had mostly focused on US companies. And then in 2017, somebody who I had worked with at First Star had built this nice private client business at Madison, and she was working on her succession plan because she was going to retire in a few years. And so she asked me if I would be interested in coming back and taking over that business. So we had a conversation with Paul Lafergie and some other of the senior managers at the firm, and joined Madison then in early 2018. And the reason I wanted to come back is my family's here. My parents are getting old, and so at some point they're going to need some help. So it was really a perfect opportunity for me. I continue to be able to do research, portfolio management, and spend time with clients. So where to next?
So next, we want to talk about your portfolio management and what you do at Madison. So we know that you specialize in portfolio management for what Madison claims are high net worth clients. And I wanted to get an understanding of what high net worth is by Madison standards.
Yeah, it's going to depend on where you are, right? If you're in New York City, it's probably a little bit different than what you would characterize in Madison, Wisconsin. So our client assets range from 500,000 to 50 million. So it's a very broad range. I would say that our sweet spot is probably $1 million, maybe probably $1 million to $4 million. So the bulk of the assets are clients that have that much money. We have over 200 clients. We have a lot of retirement assets. So a lot of it is probably half of it's in IRAs or rollover IRAs or Roth IRAs, and then the other half is taxable. We also, as you mentioned, I'm on the customized investment solutions team, and so I work closely with Anjanette on some of the insurance clients where we manage the equities for those insurance clients. And then also we have some institutional clients. So we work with some of the foundations in and around Madison.
Thank you for that. On your website, it indicates the different kinds of equity strategies that Madison has and uses. It includes large cap, mid cap, small cap, disciplined equity, dividend income, and covered call. And from my understanding, you specialize in disciplined equity, right?
Yeah, exactly.
If you can, I wanted to ask you about large cap investment strategies, and if you could describe the basics of what that is and how it works.
Yeah. So large cap investment strategies are geared towards owning companies that are essentially 5 billion and greater in market cap. And if you ask somebody for a range for each market cap size, small cap is probably 2 billion or less, mid cap is 2 billion to 30 billion, and then large cap is 10 billion or greater. So there's a lot of overlap. But in our large cap portfolios, we essentially invest in companies that are 5 billion or greater in market cap. Madison's investment philosophy, you may have seen this on our website, is participate and protect. And I'm surprised you don't have a question about that. But participate and protect is about managing risk for our clients. So with our high net worth clients, the insurance clients as well, we are interested in protecting capital. We're interested in protecting the downside risk as much as we are interested in growing the assets. So participate and protect means that we will participate in up markets, but we're not going to be the strongest performing portfolio this year. So, in very strong equity markets, we typically lag by a little bit, depending on the year and what's driving it. But in down markets, we'll protect. So disciplined equity, for example, in the March timeframe performed very well on the downside. So we didn't lose as much for people as they would have lost in a straight S&P 500 strategy. So part of our investment process is really trying to understand what the downside risks are with each investment, what the correct valuation is, and what the opportunities are for that company so that we can manage that risk and protect on the downside. And that's another characteristic that's very important to the insurance companies, because what we do for the insurance companies is we manage their capital. So I'm not going to go in depth on insurance. You should ask Anjanette for that. But all insurance companies have a pool of assets that they have to keep on the side in case they have to pay any claims. And so we're helping them manage that capital. And so obviously, if that's what you're using for your business, you don't want to lose any money. And so that's why we do this very diligent participate and protect. We really want to protect the capital.
And sorry.
Go ahead.
Oh, I was going to say a follow-up question to your investment philosophy of participate and protect is, what kind of protection strategies do you use, or what does it mean to protect? For instance, in a down market, would it mean finding the right cues to close your position and let the down market run and wait for another bull market, or does it mean something else?
Yeah, so we're not hedging our portfolios or doing anything fancy with options. Protection is really just a function of the kinds of companies that we invest in. And so and I'll describe discipline equity since that's what I'm involved in. So discipline equity is a large cap strategy that invests in high quality companies. And what does high quality mean to us? So these are companies that we think will have sustainable growth. So they're companies that are involved in an industry or end market that is growing and where we see a long runway for continued growth. So we're looking for sustainable growth. They're companies that we think have some sort of a competitive advantage, and that competitive advantage could come from their technology, it could come from their research process, it could come from their brands, it could come from their scale, so they're just bigger and better than everybody else. There are a wide varieties of ways you can define competitive advantage for companies, and we want them to be in industries where there's a moat around them, so their competitive advantage is durable and protected. Strong balance sheets. So we're looking for companies who are not highly leveraged. The key characteristic for a strong balance sheet is relatively low debt levels, strong free cash flow. So we want companies that produce free cash flow so that they can reinvest in their businesses or pay it out to shareholders. So those are the sort of the keys to the high quality companies. Capable management. So that's another characteristic we look for. And one of the questions that you had in here is, how do you do your fundamental research and where do you get this information? So we're talking to the companies. You can go to their website and you can read their 10Ks, their 10Qs, their earnings reports, their corporate responsibility reports. There's tons of information on most companies' websites, and that's really the first stop where you get information. But then we also buy research from sell-side firms. So you'd be amazed that I have 50,000 emails in my inbox. 20,000 of them are unread, but I probably get 1,000 emails a day, and a lot of that is research. And unfortunately for me, one of the things that happened is when I moved to Madison, a lot of the sell-side firms, once they found out where I was, they just turned my subscriptions back on. And so I'm getting a whole bunch of international research that is not very useful to me. So at some point I'll get to cleaning that out. But so, we do a lot of reading. We talk to analysts, we talk to the company, we talk to industry sources. So we pay for a couple of services where they can set us up interviews with former employees and stuff like that. So there's a lot of places where you can get information about a company, but we do very intense fundamental research. We build financial models on all the companies that we own and know the companies that we invest in pretty well. And so a big part of that research is really understanding what the risks are to each company's future. Is Apple going to grow next year? Apple has had a tremendous year this year because everybody had to buy new iPads and MacBook Airs and phones to work at home more effectively, right? Or study from home. And so they've had a really, really good year of product sales. As you know, they're moving towards services. So Apple TV, Apple, what is it, One, whatever their new product is that's combining a lot of it. They're charging you for storage, they're charging you for music. So the real key to Apple's future is really understanding where that service business is going to go. And so we spend a lot of time trying to figure that out.
Thank you for outlining, kind of what you look at, what factors you look at in your fundamental analysis and deciding to invest in companies. This actually isn't a question that I have on the list, and you don't have to answer it, but I think it would be interesting. Could you give an example of a company that you took a position on in one of your larger portfolios, and what reasons led you to take that position? How did you know it was well managed, for instance, and what balance sheet characteristics stood out to you that made you take that position?
So I'll talk about Bristol Myers Squibb. It's a company that we invested in a couple of years ago. Bristol Myers is a pharmaceutical company. You may have heard of it. They have a relatively strong position in cancer drugs. And a couple of years ago, they made an offer for and purchased Celgene, which is a biotech company, which also has a lot of oncology products. They're also very strong in immunology, so basically finding drugs that target diseases of your immune system. And when they bought Celgene, Celgene was very, very, very undervalued because Celgene has one drug called Revlimid, which is expected to lose its patent protection in a couple of years. And it was Celgene's largest drug, and it was more than half their sales. And so investors didn't want to own Celgene because they were afraid that the revenues from Revlimid would evaporate when it lost its patent protection. And so Bristol Myers bought it at a good price. But what happened was the reasons that people didn't want to own Celgene transferred over to Bristol Myers. So Bristol Myers was trading at 6 times earnings when we bought it. If you look at the average PE of the S&P over the last 30 years, the average PE has been 16 times. And today, the PE on the stock market is about 21 times. So trading at 6 times earnings was very, very inexpensive for a stock. And we liked their product portfolio. We liked their pipeline. We liked Celgene's pipeline as well, and thought that the combination would allow them to actually grow through the Revlimid patent expiration. So it's still to play out. We've made some money on Bristol Myers, but it hasn't been a home run yet. But we think that they're doing the right things, and so there is opportunity in their current product portfolio as well as in their pipeline. Most pharmaceutical companies generate huge amounts of cash flow, so they used some debt to buy Celgene, but they're paying that down relatively quickly. They're buying back shares. So you have things working from a couple of different directions. Also, the assimilation of Celgene into the Bristol Myers operations allows for some cost synergies. And so you're getting margin expansion, decent revenue growth, margin expansion, as well as share repurchases, as well as debt pay down. So there's a lot of things that can move those earnings higher. And so as their earnings move higher, we think the stock will follow.
Okay. I have a very basic question as a follow-up. but sometimes people mean different things by this. Obviously, all of your portfolios would seek to outperform the market. But what does it mean in Madison's sense to outperform the market? Is it beating the S&P 500, for instance?
So it depends. So disciplined equity is benchmarked to the S&P 500. So disciplined equity's goal is to outperform the S&P 500 over a market cycle. And we say over a market cycle because, as I highlighted with our participate and protect philosophy, we may not outperform in up markets, but we'll outperform in down markets. And so over that cycle, we'll outperform. Disciplined equity has actually had, knock on wood, a very good couple of years. And so this year, we outperformed on the downside in that February, March timeframe, and we're actually outperforming today. So it's been a good year so far for disciplined equity. Our mid-cap strategy benchmarks to the Russell mid-cap index. And then for small cap strategies, you'll look at either the S&P 600 or the Russell 2000 as a benchmark. So depending on what the investment strategy is, you'll have different benchmarks that your clients will compare you to. So, I wear a lot of different hats at Madison. For the private client group, we don't just, so disciplined equity happens to be a product that a lot of our clients are invested in. But we also do the asset allocation across all the asset classes. So a typical client in the private client group has large cap, mid cap, small cap, international exposure, and fixed income. And my partner and I decide how each of those clients' portfolios should look in it and direct the assets to the various strategies. And then we'll have a custom benchmark for each of those clients that's made up of the percentage of each of those different asset classes in their portfolio. So a typical client, let's say, is invested 60% in equities, 40% in fixed income. And then that 60% of equities is 35% is large cap, 15% is mid cap, 5% small, and then the rest is in international or something like that. And so for each of those categories, there's a different index or benchmark that we're scoring ourselves against and our clients are scoring us against. Does that make sense?
Yes, it does. Thank you for that. In your bio, it explained that at some of the previous companies that you've worked at, you have invested in companies, obviously within the United States, but also elsewhere. I think Japan was another country. Do you still invest in companies outside of the United States at Madison, or is it exclusively focused on the U.S.?
So we do have a handful of companies in our portfolios that are not U.S. domiciled. We own Nestle, food company everybody knows about. Probably have had one of their products today. They're based in Switzerland. And so we've purchased that through an ADR, which is an American depository receipt. So it's essentially it's traded as a U.S. stock on the U.S. stock exchanges, but it's representing Nestle shares. We own Novartis, another Swiss company. It's a pharmaceutical company. We own Diageo, which is a beverage company. They own a lot of the hard liquor brands that you might be aware of. You might have had one of their tequilas last night. Then a couple other companies we would consider them US companies, but for tax purposes, they have domiciled in Ireland or Bermuda. So Accenture, which many of you I'm sure are familiar with, a great technology company, I believe is domiciled in Ireland, but I think most of the people that I know that work at Accenture in headquarters are living in Boston. And Medtronic, we don't own that in Disciplined Equity, but another one of the large cap strategies owns it. Again, the headquarters of Medtronic are in Minneapolis, Minnesota, but they have moved their headquarters, quote unquote, to Ireland for tax purposes.
Okay. Yeah, that was a few more companies than I thought you would have had a position on. The next question that I have is about a strategy that you don't specialize in, but I'm sure you're knowledgeable about, which is Madison's dividend income strategy. My question is, what is this strategy, and why would a client seek a dividend income strategy over a more long-term appreciation strategy?
Yeah, so as you can imagine, with 250 clients, we have a lot of different financial needs and requirements for each of those clients. So a lot of times you'll use a dividend income strategy for a client who's very conservative. We have a lot of those. They're terrified of losing money. But also there's a need for income. And with interest rates as low as they are today, the dividend income strategy is pretty interesting because the yield on the dividend income strategy is 2.5%. The S&P is at 1.7%. And, the 10-year bond is at, I don't know what it is today, 90 basis points. So you're getting 90 basis points from a fixed income vehicle where you can get 2.5% from investing in a dividend income strategy. So from an income perspective, it's pretty compelling for a lot of people. The other thing is, so I'll tell you a little bit more about this dividend income strategy in particular. So it's a relative yield strategy. And so what that means is it looks for companies whose current dividend yield is higher than it has been historically. And so it has a higher relative yield today than to its historical average. And the reason that you look for something that's at a higher yield, because it means that the stock price is probably down. So you might get a double benefit. You'll get a benefit from the yield, but you'll benefit again from the PE going up because at this point, you think that the stock is somewhat depressed. The other component of this, the dividend income strategy that's important, is they look for companies with wide moats. So they're looking for high quality companies and strong balance sheets. We actually did a stress test in March when the markets were collapsing and looked at the balance sheets of all the companies to make sure that they could pay back their debt, but also that they could maintain their dividend. And so John, who's the portfolio manager of the dividend income strategy, actually sold some companies in March because he was worried that they wouldn't maintain their dividend. Because every single stock in the portfolio has to pay a dividend, and the dividend has to be 1.1 times the dividend yield of the S&P 500.
Thank you for that. A strategy that I was actually surprised to see you use, since Madison is primarily focused on long-term investment strategies, is a covered call strategy, which is a little bit more of a trading strategy. It's an options trading strategy, right? Yeah. And I wanted to ask you about how Madison goes about using that strategy. Are they long-term options contracts, like a very long expiration date, for instance? And just the basics of how that works.
Yeah, so I am not the expert on covered calls, so I'm not going to give you, I'm not even going to try to explain it because it's not something that I understand super well. We do have clients who own it and they use it as an income strategy. So when you sell an option, you gain income. So it's basically a stock, and then you own the stock and you sell the option against it. And so there's an income component. And this is also strategy that should have, you know, very strong downside protection. But as I said, I just don't understand how to use it very well. So we own it, you know, for a few clients where they want income, and otherwise we don't use it. And
okay. No, absolutely no problem. We totally know that you specialize in disciplined equity, and we have a few questions on that just after this next one, which is, can you walk us through generally what makes for a strong balance sheet when you're deciding to invest in a company? What are the things that you're looking for that make for a desirable company?
yeah, so I think we talked a little bit about this already. So the amount of debt that's on the balance sheet is really the first and most critical aspect. So you want a company that has relatively low debt. So if you can think about a company and how it operates, right? They have to invest money every day to grow their sales, to invest in R&D, and we want them to be able to fund that out of their cash flow rather than having to borrow money. And so companies with a relatively low debt to capital, so their debt load compared to the total capital of the company is a important ratio that we look at, and we want that to be below 30%. We also like companies that generate strong free cash flow, so they a lot of the income that flows through their income statement to earnings is also free cash flow. So you'll look at that. Return on capital is a ratio that we look at. We want strong returns on capital. Return on equity is another ratio that you'll look at. And so those are all indicators of strong balance sheets.
Thank you for that. Now we're going to talk about disciplined equity, which is your forte. On the website, from looking at it, the main distinction that I saw of what makes disciplined equity what it is that you focus on environmental and social risks. Can you talk about what that means and what really differentiates disciplined equity as a strategy from your other strategies?
Yeah, so it's sort of a nuanced message. Really, all of our equity strategies, their core investment processes is to look for companies that have sustainable growth, are high quality because they have strong balance sheets, capable management, and strong governance. So we are just emphasizing it a little bit more in disciplined equity. And really what it's about is driving towards not only a sustainable business operation, but also driving towards a sustainable world and a sustainable planet. And I would say over the last 10 years, ESG has become even more critical to what companies are doing. So you want companies that aren't only great companies, but you want companies that do good as well. And so we look at environmental, social, and governance characteristics to help us understand that they are focused on risks beyond their business risks. So they're looking at how they impact the communities that they are present in. They look at what their greenhouse gas emissions are and try to control that. They look at how much electricity they're using and try to reduce that. They try, a lot of companies that we talk to are investing in solar energy and wind and trying to be more efficient in the way that they basically charge their operations, right? So how they, how their plants are operating. Is it using safe energy, or is it using energy that releases greenhouse gases. We're looking at the social aspects, again, how they interact with their community, how they treat their employees, what they do with data privacy, if they're a product company, do they have high safety and, haven't been slapped on a hand because their products were damaging to people or the environment. Gender balance. So, we're looking at every company's board of directors, their management team, their overall employee demographics, and trying to understand whether they are focused on diversity and promoting gender balance across their operations. And then from a governance standpoint, you want to invest in a company that has strong corporate governance. You want to believe that the management team is highly ethical. You want to know that they conduct themselves with high integrity. Some of the things that we look for are transparency across their accounting, transparency across their tax, the way that they do their taxes, both domestically and internationally. What type of board oversight there is. So how much impact does the board actually have on management of the company, how the board interacts with the management team, what sort of regulations does the company face, and are they in good standing with all their regulators. So those are some of the aspects of ESG that we consider when we make investments.
Thank you for that. I'll be honest, I would assume that this is true for many members who are here. I had never heard of ESG screening, environmental, social, and governance before. I'm sure that's very prominent. I just never heard of it. And that was a really detailed, interesting explanation of what it is and how it factors into your decisions. A question I do have, though, is how do you get the data or the information that informs your decisions on when you're doing ESG screening? Because it's different than most data, right?
Yeah, so companies, really all the companies that we invest in now produce corporate responsibility reports. So if you go to a company's website and you search under corporate responsibility or sustainability, you'll find another whole section of their website that's dedicated to what they are doing to do good for the planet. And it's really interesting. Because one of the things that we found as we've been doing this research is that the corporate responsibility and the sustainability really engages the employees, because it makes the employees feel like they're doing something good for the world, not just, if you worked at a pharmaceutical company, you would probably feel like you're doing something that was good for the well-being of the world. But, working at Nike, where you're producing running shoes or t-shirts, you might get excited about a great new running shoe, but I think you'd probably get more satisfaction about doing something that's really great for the world. And so the corporate responsibility and sustainability aspects really engage the employee base. So, you can talk about community. So a lot of the sustainability reports will talk about how the employees, how they dedicate their free time to doing, what's the word? Volunteer work. So they, some of the technology companies will have STEM oriented groups that will go out and tutor kids, teach kids how to do complicated math. They'll talk about how much money they raise in their charitable campaigns and how much money, each employee might dedicate from their paychecks to supporting various organizations in the community. You know, some of the banks talk about the investments that they're making in cities that they have big presences in. So for example, JP Morgan Chase has big operations in Chicago, Detroit, I think in North Carolina as well. And so in some of those key cities, Detroit and Chicago, they talk about how they're investing in the community and doing things like that. So that sort of thing really engages the employees, and so it's really nice to see, you know, all the excitement around sustainability.
Thank you for that. And I want to let members ask any questions that they have, because I know that they have quite a few. I'll mention one that came up pretty early on in the meeting from Kunal, I believe. And he said, can you talk about some of the strategies that you deploy to protect money in large cap funds?
So we touched on this a little bit.
Yes.
You know, the protection it's not really using options or holding large cash positions in the portfolio. It's really about making investment decisions that have less risk. So one of the things that we present to our clients in reports is a chart that shows, on the y-axis, it shows the returns of the portfolio. On the x-axis, it shows the standard deviation of our portfolio and or the S&P. And so there's a dot for the S&P and a dot for our portfolio, and our portfolio has similar or better performance with less risk. So it's really, you know, owning high quality companies that have consistent, durable businesses. You know, Procter & Gamble, Costco, these companies have relatively, you know, consistent, durable, predictable businesses. They're not going to change a lot. They grow every quarter, but it's not going to be up 10% one quarter, down 10% the next. It's going to be fairly consistent growth. So you look for that consistency. You look for those strong balance sheets, and then you have to, you know, try to understand what the potential risks are for every stock that you own. So, you know, with the pharmaceutical companies that we own Lilly as well, and Lilly is about to report data for a drug in their pipeline that's a new diabetes therapy. And if it works, it's going to be a blockbuster. And blockbusters means that it's going to be over $1 billion in sales relatively quickly. And so we're super excited about it, but we have no idea whether it's going to work or not, right? Even though the phase 2 data was very compelling, they have to replicate that data across a much larger patient pool in their phase 3 clinical study. And so we think Lilly's interesting at this price, but we don't want to add to it in front of that data, because if we're wrong, the stock could go down 5 to 10%. So it's really thinking about you, to protect your downside risk, you manage, you try to understand the risks for each company, but you also manage the position size, so that you're not going to have your biggest percentage of holding in a name that has a lot of potential downside risk. You want it to be more predictable than that.
Thank you for that. I actually mixed up another person's question with Kunal's question. Kunal's question is, can you talk on your exposure in emerging markets, if you have any?
Yeah. So because we invest in large cap companies, all our companies, or virtually all the companies in the portfolio, are multinationals and have businesses all around the world. As you know, emerging markets are growing more quickly than the developed markets, and so they're interesting places for all these companies to be. So they all have exposure to China, India, Brazil, and other countries as well. So we have that exposure. So one of the things that you would see if you looked at the asset allocation for one of our clients is that they have a lot more exposure to US large cap than you might see with other people who manage high net worth, because we think we get enough international and emerging market exposure within our investments in Apple or Lilly or Bristol Myers, whatever, because of their mix of business. However, we also do invest in emerging markets for our clients, and with strategies that we don't have expertise in at Madison, we will find mutual funds or ETFs to use to gain that emerging market exposure, or if we want to add to it. And right now, we are using the Barron Emerging Market Fund. A guy named Michael Cass manages the Barron Emerging Market Fund. He's got a lot of exposure in China. He invests thematically. So he's looking for sustainable growth. He's also sort of categorized his portfolio into certain themes. So there's a lot of exposure in Asia and China in particular from that fund. And they've had a very strong track record. And so it's one that we're really comfortable using to get emerging and market exposure. There's also a company called Matthews, M-A-T-T-H-U-W-S, that focuses on Asian mutual funds, and they have some interesting Asia-based funds that our asset allocation team actually uses.
Another question in the chat, and you did speak to this, you did say, of course, that you look at workplace diversity as when you're doing ESG screening, but I think this question might be more about the criteria. She mentions a report from McKinsey that says that companies that have 50% or more women in leadership roles have 8.5% higher profitability. Is this something that you look at?
Yeah, so when I was at Wellington, I helped to start, Wellington's a investment firm with about 2,700 employees, and I was there, I think you heard, for about 16 years. And while I was there, I helped to start their women's network. And one of the things that we were looking at was that we read a lot of those reports that came out that said women are better portfolio managers because they're more conservative, is really the end result. They don't take as much risk in making their decisions. But also that idea of having a diverse management team, having a diverse board, you're making better decisions. And so at Wellington, what they tried to do was have a diverse committee. Wellington is run with a lot of different committees, and so they made sure that each and every one of those committees was diverse so that they were making the best decisions. Madison is only about 85 employees, so we don't have the flexibility to do things like that, but we certainly are in agreement with those reports that suggest that having diversity of thought gives you the best results.
Absolutely. The next question is, what is the typical number of stocks in a portfolio that you manage?
Yeah, so we run our portfolios a little more concentrated than I think you'll find most mutual funds. I mean, a lot of mutual funds have 80, 100, and even sometimes, depending on the size of the fund, potentially more names than that. We run our portfolios anywhere from 25 to 40 names. So our mid-cap portfolio has about 25 names. discipline equity has 40. I think large cap core has somewhere in that 30 to 35 range as well. And dividend income has about 44 names.
Okay. Francisco Rodriguez asked, one, with current valuations so high and with the surrounding uncertainty, political, economic, what sectors do you target these days?
Yeah, so we've been, Francisco, we've been defensive really all year. So we came into 2020 thinking that the market was close to fairly valued at the beginning of the year, and it was 18 or 19 times at that point. Then we went through the pandemic when the market crashed, and then you had the Fed and the government provide a tremendous amount of liquidity and support to the economy and to the financial markets. I mean, a lot of the Fed's programs were directed at restabilizing the financial markets, because there were a lot of things that went wacko, I don't have a better word than that, but a lot of things were unusual in that March timeframe, because what was going on, as you saw the market slide at the end of the month in March, is everybody was just racing for the doors and selling whatever they could to get liquidity. So you saw various parts of the fixed income market get locked up. And so the Fed came in to basically straighten things out. And so you had a very quick reaction by the Fed, and you've seen the market going straight up ever since then. And we think that today the market continues to be fueled by that liquidity and the fact that the Federal Reserve, that Jay Powell has said, we're not going to raise interest rates for 2 or 3 years. So with interest rates close to zero, it's providing, it's pushing more people towards equity markets, because that's really the only place to get returns. And so when we're adding to new names, we're looking for, because of our participate and protect, and because of our discipline about looking at valuation, we're really only adding names where we think the valuation is attractive. So one of the stocks that we added to the portfolio in the last couple of months is Qualcomm. So Qualcomm, as you know, is a technology company that creates a lot of the technology that's in your cell phone. And they have the technology for 5G. So for the 5th generation of cellular technology, they're the leader. And so they get, for every 5G phone that will get sold, they will make a little bit of money, because they get royalties on that. And as the 5G network gets built out over the next few years, we think that Qualcomm is going to have a tremendous growth opportunity. The other part of the Qualcomm story was that they, because all the cell phone manufacturers don't like paying that royalty, they were suing Qualcomm, because they said, that's unfair. You can't, why should you get a piece of every single cell phone? And over the course of this year, Qualcomm has won most of those cases. So the judges are saying, you know what, it's Qualcomm's technology. They created it. If you want to use it, you need to pay them. And so the legal burden was taken off of Qualcomm. And so we thought it was safe to go back in without having a big chunk of their revenue potentially taken away from them. So what was attractive about Qualcomm is we expect, to have strong growth for the next 2, 3, 4, 5 years. And it was only trading at 15 times. So it was trading below the historical average for the market. And so we bought a position. They just reported a great quarter, and the stock's up quite a bit from where we bought it. But that's sort of the way that we're managing around these high valuations. One other thing that I'll say about valuations, though, is we haven't sold all our winners. because they're trading at high valuations, because low interest rates could justify higher PEs. It's just hard to figure out what that higher PE might be. So unless there's been a big fundamental change, whether there's been a big, whether their revenues or earnings have changed dramatically, we're not going to sell it. So Accenture or Visa are two good examples. They're both companies that are trading at something like 30 times earnings, but it's because they're high quality companies. They have very consistent earnings growth. And so unless something blows up in terms of their operations, we're not going to sell out of the position. We might trim it if they get a little too expensive, but we want to own those companies long term.
The second part of this question is, in your opinion, is a quote great company ever too expensive to buy?
Sure. We don't own Amazon. We think Amazon's a great company, but we just can't get our arms around the valuation of Amazon. I owned Amazon at both Wellington and Artisan, but when I came to Madison, they didn't own it, and so we haven't purchased it. I'm trying to think, some of the technology companies, Netflix, we don't own. I mean, Netflix is not just a valuation issue. It's also, they have to invest a ton of money for their content. And so they're actually a more leveraged company. They don't have a strong balance sheet. Tesla is a name that we haven't chased. So yeah, we think that there are companies that you'll just have to watch, that we're willing to watch from a distance because they look too expensive.
The next question is from Jeremiah, and the first part of this question, you've talked about at length throughout this whole discussion. But the full question is, how do you choose which stocks to include your portfolio? You spoke to this a lot, obviously. And do you frequently update it? That is, replacing stocks that are not performing well with better performing stocks.
Yeah. So when we buy a stock, we want to believe that we can own it for 5 to 7 years. And so when we're thinking about their opportunities, we're thinking about what they're going to do over the next several years, not just in the next quarter or the next year. If we could build a portfolio and never do a trade, that would be the best. Like to buy a bunch of stocks, put them in a drawer and never look at them, that would be the most ideal situation, but we're not that good. So we do have to do trades, but our turnover is probably 20 to 30%, maybe 20 to 40% in a year where we've gotten rid of more things. So, because our strategy is to look for sustainability and sustainable growth, when we buy something, we're pretty committed to it for a long time. But we do sell things and buy new things. So right now we have a couple of stocks that are sort of on the list for source of funds, but it's harder to find those attractive Qualcomm-like position, like opportunities to get in at a price that we're comfortable with. So that's one thing. The other thing is we do think that once we get through this election cycle, I think this morning Georgia said they're going to do a recount, physical recount for the election. But once we get through the election noise, we know who the next president is, we know what the Senate's going to look like, what the House looks like, and as well as we need to get through COVID, or at least have an understanding of what getting through COVID looks like We probably want to own more cyclical areas in our portfolio. So we've been defensive, as I think I mentioned, owning consumer staples and owning healthcare, owning very predictable companies that have sales regardless of what the environment is. And we've had less exposure to consumer discretionary and financials, some of the more cyclical areas. So we have been looking, we're trying to find names in consumer discretionary, industrials, and financials that we want to get into once the outlook on the economy is more clear.
Thank you for that. And what is right now the last question is, do you look at real estate investment trusts for stable dividend income at all? With bond yields so low, is it reasonable to have equity/bonds being a 60-40 split in portfolios?
Good question. That's what a lot of our clients are wondering. So we do own REITs in some of our client portfolios. We have one client in particular who, it's an insurance company, and he wanted us to build a portfolio of real estate investment trusts to put in their portfolio. And he thought that there would be downside protection, and they actually performed horribly this year. But they have 6 or 7% yield, so he really likes that income stream that they provide. But they had virtually no downside protection this year. So what we've learned about REITs, and we told him last fall when we built this portfolio that we didn't think that they were going to have the downside protection that we thought they were going to have. So he admitted that he was wrong, which was a pretty amazing thing. But COVID is such a unique recession that, as you know, because everybody's working from home, why do you need a corporate headquarters? Why do you need an office building in New York City or downtown Boston if everybody's working from home? So real estate investment trusts invest in real estate, and if there's any question about whether they're going to get their rents, the stocks aren't going to do well. So we did build a portfolio of REITs that we thought would do better in protecting the downside. So we invested in some healthcare REITs. But even those, a lot of the healthcare REITs were like the office buildings, they were closed down for a period of time. So you have to be careful of what sort of REITs you're investing in. And then this idea of 60-40, there have been a ton of articles out there. You know, historically, the bond part of the portfolio acted as the hedge against your equities. And with the Fed being in there and what they've done with interest rates and what they've done basically with the fixed income markets, fixed income's just not providing that hedge that it once provided. And so when equities go down, bonds don't go up anymore. They don't do anything because there's no interest rate. And so what we have been telling clients is that they need to think about their fixed income as a capital preservation tool, and that's it. They're not going to make any money there. They're not going to get a return because interest rates are so low. So over time, they probably will want to increase their equity exposure if they need that portfolio to grow. So it's a good question. It's something that we're still trying to figure out, like what the best thing to do for our clients is, because we have a lot of clients who depend on us for their retirement, and they need that money to last them for 20 or 30 years after they retire. So that's really the message I should end on. When you guys get a job and they give you an opportunity to invest in a 401k, put as much money as you possibly can into that 401k. And, you know, if you have a good enough job that leaves you some money on the side after you've paid for your rent and other expenses. Put it in an investment fund and just put, you know, even if you're just putting $100 a month or $50 a month, put it aside, because what you'll see is that compounding return on those assets, and you'll be well positioned when you do want to retire.
Could you talk about the characteristics of a financial advisor internship you are looking forward to see?
Can you, I don't quite understand the question.
Oh, I mean, what kind of characteristics of a financial advisor internship you are looking forward to see?
The financial companies? So when I said that we wanted to invest in financials, is that what you mean? Or just broadly across the portfolio, what sort of financial characteristics?
I mean, financial advisor internship.
I think maybe talking about like an internship at Madison.
In the summers, we often look for interns. It's at this point, it's too early for us to know, because we're not quite sure when we're going to go. Our office is shut down right now. We were going in a little bit to the office until earlier this week, but we've decided to be safe and shut down again because of the COVID cases in Wisconsin. But we have had interns in the past, but it's just, I don't know what we'll be doing next summer. So, you know, maybe in February, Louis, or you can reach out to Ann Jeanette and she can put you in touch with us. But the U.S. equity team usually has 1 or 2 interns. I don't know that our fixed income team has had interns.
Okay, thank you.
Yeah.
Okay, well, I don't think that there are any other questions, and I think that this has probably been the most informative discussion that we've had since the start of this semester. It's been hard to host and manage events, obviously online, it's not the same, but this was, you know, a really detailed discussion, whereas most are kind of more broad and just in overview. So I really appreciate you coming out. There is one last question. If you do have 1 or 2 minutes to answer, it just got put in the chat, is, while buying stocks, do you consider the intrinsic value of the stock?
Yeah, so that's one of the keys that we do try to do, is determine the intrinsic value. So our mid-cap team is very oriented towards that. When we do our buy thesis reports, they'll have an intrinsic value that they've determined on that report. So yeah, we're definitely trying to figure that out.
Okay. So I'll just finish up in saying exactly what I was saying before. Thank you so much for coming out. Honestly, this has been a great discussion. Anybody in the chat, if you want to thank Maya for coming out, you know, unmute yourself, say thank you. This is really a great discussion. I thought that it was useful for every member who came out.
Thank you, Maya. I really appreciate your time and a lot of information that I gained, especially on managing the large cap funds, and you know, how you one thing that is relevant for me is, like, you know, you can hedge your protection by, you know, diversifying your investment. So that was a great take for me. Thank you so much for your time.
Good. Well, thank you. This has been fun. Louis has Ann Jeanette's email, and so if you do have follow-up questions or anything else that you want to ask, just send them through Ann Jeanette and she'll get them to me and we can continue this discussion. But good luck to all of you. It's a great business. It's a lot of fun, intellectually challenging every day. So I would encourage you to pursue the investment world.
Thank you.
You're welcome. Have a good day. Take care.
Maya, thank you very much.